So we're here today with Teresa Majors, my partner at Dopkins and Company. I'm Greg Urban, and we're here to talk about the Tax Cuts and Jobs Act, specifically some individual income tax provisions. Teresa, what do you think the highlights are from the on the individual side with the tax cuts?
Well, you know, a lot of taxpayers were hearing about tax rates are getting cut. So what does that mean to me? Well, the tax rates under the new law are broader and wider than the old ones, and they're a little bit lower. I mean, not huge, but lower. So that could be helpful to a lot of people. The other big thing that we heard a lot about is the increased standard deduction. So the standard deduction is the basic deduction that everybody gets, whether if you don't itemize your tax deductions. So the single people would get $12,000 under the new law, head of household gets $18,000, and married filing joint gets $24,000. Now, the other thing that changed is personal exemption. So Greg, you would get a personal exemption, one for your wife, one for your child. Under the old law, under this new law, those go away. So the impact of these changes are going to differ for different people. So when we talk about standard deduction, the flip side of that is taxpayers itemized. So why don't you tell us what changed in the world of itemized deductions?
Yeah, for sure. In our practice, most of our clients and most taxpayers would take an itemized deduction. I think going forward, like you say, more taxpayers will take a standard deduction, and probably the itemized deductions won't be available. The reason for that is major change from the Tax Act. Tax Act eliminated, for the most part, a deduction for state and local income taxes and real estate property taxes. It's only limited to $10,000. In high tax states like New York, where we are, taxpayers really relied on a large itemized deduction for state income taxes specifically. So $10,000 total real estate taxes and income taxes. The other big itemized deduction change, I think there's two areas. First would be in the area of interest that's related to home ownership. Change number one, no more deduction for home equity interest. Previously, we could take a deduction for $100,000 worth of home equity indebtedness. Now that deduction is gone. The second part of that is interest attributable to the acquisition of a residence. Used to be that interest on the first $1 million of acquisition indebtedness was deductible. Going forward, that deduction for the interest is only going to be allowable to the extent that it relates to the first $750,000.
And just to clarify, that change is only for newly purchased.
Absolutely.
So there's some grandfathering, got to be aware of some dates.
Right, so a mortgage in existence prior to
a new house, this is something you got to be focused on.
Yeah, I think the third area in the itemized deduction arena, if you will, is going to be the elimination, at least temporarily, going out through 2025 for the deduction related to miscellaneous itemized deductions. Those most commonly were probably deductions related to maybe unreimbursed business expenses or other expenses.
Like investment advisory fees.
I was going to say other expenses related to the generation of taxable income, investment advisory fees, tax preparation fees. Those will no longer be allowed. So the combination of those three areas, I think, will impact taxpayers.
So that's a good point that you made, though, the 2025. So when we talk about any of these individual related tax changes, this is only through 2025.
Yeah.
And then, who knows what it's going to look like. So this is, not considered a permanent change. It's a temporary change
for sure.
all of these provisions.
For sure.
So I guess with this changes in the itemized and the standard deduction, would we expect to see more people taking advantage of the standard deductions now?
I definitely think you'll see more people take advantage of the standard deduction. There might be some planning opportunities around, because when you think about itemized deductions, there still is a deduction allowable for medical costs, and the deduction for charitable contributions is still allowed. In fact, it might even be a little bit more favorable. So. Have you seen any planning around the charitable?
So the one thing that I've been thinking about and talking about is the fact that so take an example of a married filing joint. You've got a $24,000 standard deduction, and I'm a New York State resident, so easily I have $10,000 of state and local taxes. Well, what else do I have? Well, maybe I'm pretty generous and I'm making $15,000 charitable contributions a year. So now I've got a standard deduction of 24, and my itemized are 10 of state and local plus 15 of charity, so I've got 25. So it's like, great, I got a benefit, but I don't feel like I got a benefit out of 15. I feel like I got a benefit of 1,
Yeah.
which isn't that exciting, right?
Yeah.
But if I were to take advantage of maybe bunching those charitable contributions, putting, in 1 year, making a donation to a donor-advised fund or a community foundation, some charitable vehicle that would allow me to kind of spread out those charitable, my charitable giving over a number of years to the charity, but me as an individual, I get the deduction all in 1 year. I would feel like I got a lot more of a tax benefit from that. So that's what, I've been talking to some clients about, and it's, I think, of fairly broad interest if you're in that range.
When I think of these itemized deductions, I also kind of start to think about the AMT, right?
Yeah.
So, big changes in the Tax Act with regard to the alternative minimum tax. I don't know about you, but a lot of my clients, the clients I work with are in the alternative minimum tax. And major change with regard to the alternative minimum tax was really on two fronts. One, there's an exemption in computing the alternative minimum tax. That exemption has increased from about $85,000 up to over $100,000.
Yeah, so it's a substantial difference.
Yeah.
I mean,
the other thing I think that you saw is a lot of taxpayers, that exemption would phase out.
Yeah.
Now the phase out, the income at which the exemption phases out is much higher. It's over $1 million.
And then why were they in AMT in the first place,
Yep.
right? They were in AMT because they had a lot of personal exemptions. Perhaps they had multiple children. They were in AMT because state and local taxes are very high, and that would push them up, and that's was not deductible for AMT. Or if you have somebody who's a big investor, perhaps they've got a bunch of investment expenses that are also not deductible for AMT. Now, this stuff is no longer deductible for regular tax purposes, therefore no AMT add backs.
Yeah.
So even at a higher income taxpayer who could be subject, I would expect to see less of it.
Just fewer add backs.
Right.
I think there's maybe just two other things that I think about when we think about the Tax Cuts and Jobs Act. A lot of questions from clients relative to capital gain and qualified dividend rates. I think it's safe to say there's really no material changes in those areas.
Yeah.
And then a lot of questions come in about state taxes. Want to go through what the changes are relative?
So the big changes for in the estate and gift area is that under prior law, the estate tax exclusion for an individual was in the realm of $5.6 million. Well, now, starting in 2018, it's doubled. It's about $11.2 million. So if you are lucky enough to have an estate that's somewhere in that 5.6 to 11.2, and those numbers are doubled if you're married, this is a good time to think about if there's any strategies you might want to take advantage of.
Yeah.
Because as we talked about before, these individual provisions are all temporary. So in 2025 it goes away. So for somebody who dies between now and 2025, those really high limits apply. But if you're younger, but you have the intent and the capacity to maybe do some substantial gifting, maybe this is the time to think about it. So I think those are some important considerations to just be aware of.
Yeah. The other question that came up is portability is still
out there.
Yep.
So if you have spouses, that you get that double benefit. And I guess the other thing to just think about though is to be aware, like for us living in New York State is, for estate taxes, has a different threshold.
Yeah.
However, there's no tax on gifting, so you still could do the gifting.
Yeah.
So it's a good thing to think about.
So hopefully this short clip provided some insight into the individual changes that really resulted from the Tax Cuts and Job Act. I think it's safe to say that there'll be a lot of clarification and interpretation forthcoming from the IRS, but if you've got any questions, we encourage you to contact your Dopkins and Company tax professional.
Thank you.